Hi, my name's Scott Dahl. I would like to thank you for tuning in to another one of my podcasts. Very exciting time we've had the first 5 weeks. I'm recording this on February 5th, right after the market close, and we have seen extreme volatility. Now, if you go back to two previous podcasts, if you haven't watched them already, you go back about a month ago, I did a podcast titled, Are We in a Market Bubble? And I said at the time, no, I don't think we're in a market bubble. I believe we're headed higher, but we should see a correction. We were ripe for a correction, and we had a correction. We had a soft back end of December, and it continued into January. But then 3 weeks ago, I put up another podcast that I felt was timely, and it was called Market Correction. It was describing the correction that we were in. It was taking a look at where I thought we might go, how deep we might go before the market recovered. And then you can look at that as well. And then to build on that, what I've titled this presentation is Sideways for Now, and let's take a look at that. Before we look at the actual charts, I want to point out two phenomena that I think are important. Number one is you've all heard of the January effect. The old adage is, as January goes the year. And why do people say that? Well, obviously positive front end of the year, that doesn't guarantee anything, but it should bode well for future performance psychologically. But if you go back to 1950, 89% of the time since 1950, if January is positive, the year is positive. So almost 90% of the time, the average annual return has been 17%. So there's strong historical evidence that we should have a continued good year based on this January effect. Secondly, is I just want to point out a minor caveat that we typically have a weak February, but it's back end loaded. It doesn't necessarily sell off until after Valentine's Day. So we should see some weakness here in February. Let's take a look at the charts. And here is what is called technically a sideways trend. So the market can correct one of two ways. It goes up, and then what happens is it goes down. And when it goes down, it's a counter trend move. And what happens is the people who don't have the fortitude or the financial wherewithal to stay in, they get out. So it purges the market of speculative excess. And then the market can go ahead and recover, and it can make new highs. Well, there's a second way to have this market correction, and that's a sideways trend. Not one is not necessarily better than the other, I don't think. But what happens in a sideways trend is just what the name implies. The market trades sideways, and inside this sideways trend, there's a lot of churning. There's a lot of buying and selling that goes on. So the sideways trend is a corrective move as well. We're currently in a sideways trend, and I'm gonna show you examples of that right now. So let's take a look at the first chart I have up, which is the New York Stock Exchange. This is a daily chart of the New York Stock Exchange. I have drawn trend lines across the top and across the bottom. And this is a daily chart. It started in December, the sideways trend, and that's what we're seeing right now. We're seeing the market trade sideways. This is a corrective move. Secondly, if you take a look at the Dow Jones, perfect setup. This is certainly an example of a sideways trend. This is a downtrend, down to sideways maybe. It's the mid-company U.S. stocks. Here is the RSP. Remember, I talked about the RSP in previous podcasts. The RSP is a equal-weighted S&P 500. So instead of weighting the larger companies, instead of giving them more weight like it does in the S&P 500, every stock gets an equal vote. Every stock is equally weighted. What do you have? You've got another sideways trend. Next index, this is interesting. This is the small company stocks. They've been in a sideways trend since November of last year. This is the S&P 500. This is another perfect example, like Dow Jones. This is a perfect sideways trading channel. This is the NASDAQ. This is the tech-heavy NASDAQ. What do you see here? Sideways, maybe sideways to down, but definitely a sideways congestion area. And lastly, I wanted to point this out. This is the XLG, which is an exchange trader fund that represents the top 50 growth companies in the S&P 500. And what do you have? I'm going to blow this up a little bit so we can see it. This is a sideways trend that has been going on since mid-December. So what the sideways trend, typically what happens is it resolves itself in the direction of the previous trend. So the direction of the previous trend was up. You go sideways, and then you typically break out to the upside. There's no guarantees. You break out to the downside. If we break out to the downside here, then there's this bull market, the cyclical bull market could be over, or the correction could certainly deepen, but we would expect it to break out to the top side. Another thing about sideways moves, The bigger the base, the bigger the resulting move. So the longer that this congestion phase remains, the more you're going to see this churning, this buying and selling that's going to alleviate what I believe is an overbought situation in the market. So I believe that we are in a cyclical bull market and a secular bear market. We're in a shorter term bull market in a long term, high inflation, high interest rate bear market. Similar, maybe not, it won't be the same, but similar to the 66 to 82 period. So enjoy this while it lasts. It's more than likely going to continue here for a while. One other thing I want to point out is active versus passive. Passive investing is just buying an index and not even looking at it. Active management is actually picking individual stocks, trying to outperform an index. It was easy last year, and as I stated in the previous podcast, it was too easy. All you had to do was buy the S&P 500 or buy a major index, and you would have made money. However, last year, for a lot of the active managers like myself, if you were picking individual stocks, then you had better returns than the indices. And I think that that's going to be more accentuated this year. I think it's going to continue. So you're going to need to be able to pick the proper stocks throughout this sideways trend in order to make good money. So the index may not go anywhere for a while. Might, but it may not. But if you're picking the right stocks, you should have a pretty decent year this year with obviously no guarantees. So with that said, if you have any questions about what I had just shown you, if you have any questions about previous podcasts, if you would like me to take a look at your portfolio to make sure you're positioned properly, I'd be more than happy to do that. You can reach me at 949-497-6366. It's Scott at DowellCapitalAdvisors.com. That's CAPATAL, advisors with an O. Or you can simply go to my website, which is DowellCapitalAdvisors.com. You're watching Dowell Capital Insights, my podcast. I'll be looking forward to putting another one up. Give me a call if you have any questions. Thank you very much.